So good afternoon, everyone, and thanks for joining us this afternoon. So for the next 25 minutes, we're going to be discussing the new stage of the seed stage. And today, by seed, we will merging the pre-seed and seed stage. And we're not going to cover angel round. We're going to cover when VCs invest, or another word called institutional round, right? So without further ado, I will ask the panelists to introduce themselves. And I'm asking you to cover a few things during your introduction, coming from your name, your fund, your check size, your sector focus, as well as geography. In a nutshell, what is your investment thesis, right? So, Eva?
Yeah, thank you. Hi, everyone. It's a pleasure to be here today. And even more fun to be here, my friends Sarah and Jenny. We work together closely. Again, my name's Eva. I started a fund called Fika Ventures about 5 years ago. We have 350 million under management, LA-based, and we invest in North America. Very focused on enterprise software, anything B2B, fintech, health tech, and a lot around cloud and AI. Check size 1 to 5 million to start.
Hi, everyone. So excited to be here. I'm Jenny Fielding. I run a founder community and venture fund called The Fund. We invest in pre-seed, but we do that globally. So we have investments, 230 of them around the world. Our check size is about 250K into pre-seed rounds that are usually $1 million, 1.5. And yeah, we can invest anywhere, which is pretty exciting.
Awesome. I'm Sarah Kunst. I run Clio Capital. I'm based in San Francisco, but invest broadly around the U.S. and will look at anything as long as I can sue you in the Delaware court system. So if you're a U.S.-based entity, and I primarily invest at pre-seed, $500,000 to $1 million checks. Really coming in as the lead, happy to take board seats and write founders checks so they can get back to work.
Awesome. Thanks a lot. So compared to last year, how active are you investing this year? Like now, how much are you investing?
Our pace hasn't changed, so we do very concentrated bets in about 10 companies every year. So the number of companies we do are the same, but I would imagine the process has changed a bit more. We're allowed a bit more time. I think last year we had to rush for a lot of these deals and often overpay. And today, I think instead of making a decision in 3 to 4 days, I feel like we have more 2 to 3 weeks, which is a much more enjoyable process because we really get to know the founders.
We're pretty active. We'll do about 50 deals a year, and that's a combination of kind of our 50K checks and our 250K checks. And I will say things have slowed down a little bit. Not that we're seeing less deals, but the pace of the deals getting done has slowed. So we're a little bit behind pace, but in the last 10 days, I've closed 3 deals, so we're pretty active.
For me, I would say that the deals have continued to pace. The biggest kind of rate limiter, or the thing that's been slowing us down, and I think you'll hear this behind closed doors from a lot of investors, is that the world has changed a little bit in terms of valuations, and founders, you get to tell me kind of what you're willing to accept. But if you send me a deck, pre-seed idea on a napkin that says, I want 2 on 12. I tell you that I want a pony, and we kind of go our separate ways, right? And so the biggest thing I've seen and that I've been hearing from peers all the way up through some of the biggest funds in the world, who lead massive Series A's and B's, is that it's just really hard when the founders are sort of looking for peak 2021 valuations in a world that has cooled, I would say kind of 20 to 30%.
So for each of you, if you have to sum up in one word the current seed landscape situation as of now, what would be your word?
Volatile.
Yeah, I'd say a little tumultuous.
I think it's an opportunity.
Opportunity. I love that. Very optimistic, right? So you mentioned valuation being a little bit crazy, right? And we have seen the last year or two, valuation going super high, deal closing super fast. But there's also a sentiment that maybe is going down and valuation are going down because it's what we're seeing on the later stage, like A, B, and even if public listed company. What are you seeing on the seed stage? Are you seeing valuation going down? Are you seeing things differently these days, or should we expect anything changing?
Yeah, so I guess we just got a new batch of data from CB Insights, and we've been watching it closely the last couple of quarters because often these prices are lagging indicators. But seed has been more sheltered than late stage. I think late stage, I think the drop has been up to like 50% for Series B and beyond. But for the seed, valuations have remained fairly high. I think deal volume has decreased a bit, but I was really surprised that actually the prices have gone up by 25 to 30% in rounds that were less than 5 million.
I think where we play, which is slightly smaller rounds, what we'd seen, and I think Sarah mentioned this, was almost these party rounds where a founder would kind of self-price, right? So they'd say, I'm raising $1 million, it's a safe, and I'm going to do that at a 10 or 12 post-money. People, and mostly fill it up with angels, microfunds, and people like me would have to, either invest or not. I think what we're seeing now is that we actually have more leverage to help set those prices. And so what I'm saying, and I actually tweeted about this a few weeks ago and got a lot of flack from founders, is that that was very 2021, and unless like Eva's pricing it at something that I consider high, whether that's 10 or 15, then I'm going to kind of wait. So those founder price rounds, I think, are not getting done as quickly.
Yeah, I actually think that the next 6 months are going to be a really interesting time for company creation. When I say I do pre-seed investing, that means that if you still have a job, you're thinking about quitting your job, you're thinking about building something, like that's how early I'm excited to get involved. And the reality is that if you were sitting at a Klarna or Stripe, and I love those companies, and it's really frustrating to see what's happened to them, if the equity that you hold on paper has taken a 70, 80% nosedive, then you're kind of like, what am I sticking around vesting for? I can probably make them, let me wait to exercise the options, and I can leave and I can go start something. And so I'm really excited to see, between unfortunately the layoffs and the reductions in force and the lack of sort of, IPOs and all of that, I actually think it's going to unleash a whole new wave of great founders on the ecosystem. And while I certainly wouldn't wish for this sort of downturn we're in, the best kind of funds and the best kind of startups tend to start in downturns. And so I'm cautiously optimistic for it.
Yeah.
Awesome.
And
so valuation is one of the terms we have in a term sheet, right? Or in a shareholder agreement, but there's many other terms. So you mentioned the speed is slowing down, valuation you agree on is maintaining, but have you seen evolution on the other terms?
Yeah.
All the basically the negotiation between VC and founders is going on.
Yeah. I think before I get there, I wanted just to comment on Jenny, because I know there are founders out here. I think 2 years ago, a founder will say, like, I want to raise $3 million and I want to be diluted 15%. Like, you do the math and like that's what you're going to pay. The dynamics have changed where I think investors are like, well, let's really assess the quality of the team and the intrinsic value of what we have here today. So that's a fundamental shift, and some balance in between is probably the healthy one. In terms of like term sheets, at the seed stage, it's still pretty vanilla. Like, I think people are still using safes. There are probably some outlier investors, whether it's because of lack of sophistication or maybe they're trying to be a little predatory, where they're inserting weird terms like weird liquidation preferences and things like that. I think if you're out there raising, I would say definitely rely on the founder community as well as the VC community to like double check, because those terms will stay with you and often be a noose for many years to come if you sign the wrong term sheet early on. And there's definitely more behavior like that now.
And to add on that one, I think be especially cautious when you come from emerging markets, when there's way less competition. Be very careful on your term. Go check what is best practice in the US or in your markets, but don't trust what VC will going to tell you. That is the norm and you should accept it. Do your homework, right?
Yeah, so I think another change, again, not in the term sheet, but kind of, in the process, is most of us want to make sure that you can get through 2023, and so we're looking for you to raise probably a little bit more money than you would before. So in the last few years, there was an expectation that you could probably raise every 9 months. So maybe you'd capitalize for 12 months, maybe 18, and I think most of us now are saying at the early stage, well, 500K is probably not enough to get you through 24 months. So I'd say that's like a big change that I'm seeing and that I'm suggesting to founders. Raise a little bit more because we don't know how 2023 is going to play out.
Yeah, I think a huge advantage you have when you're not sitting in, New York or San Francisco or Hong Kong or another city where you pay $1 trillion a month to rent an apartment smaller than this stage, is that you can raise a decent amount of money and have that runway last a long time. And so, I was talking to a VC from the Baltics last night, and being from a smaller ecosystem where you're used to being a little bit scrappier is a massive advantage right now. Similar to where 18 months ago, being from San Francisco and saying, hey, I have $250,000 of student loan debt, which Europeans don't even know about that. Don't get me started on America. And I also have a $1 million house. It's a 1-bedroom house, and I'm used to making $250,000 a year at Google. Oh, you work at Google? Well, here you go. Here's your seed round, right? And now I think it's, you can hire how many engineers in Estonia? That's interesting. Let's have that conversation. And so, these kinds of these moments, I think, are a huge opportunity for people in smaller markets to kind of come out from behind and say, hey, what you might have seen as a relative weakness a while ago is actually going to be our relative strength.
So one of the trends that is accelerating is also a lot of more solo GPs. So usually a fund will have 2 or 3 GPs running the fund, which are the equivalent of the co-founders. What are your views on the solo GPs? Do you like to co-invest with them? Do you feel they're highly capable people, or you feel they're very restrained in terms of time and ability to support? How do you see solo GPs?
I mean, I love the solo GPs. I love the trend in the last few years of basically anyone being able to be a venture capitalist. So I was able to start my fund because I use a platform many of you have heard of called AngelList. I mean, my first fund was $5 million, and I couldn't start that fund in the old way, right? It would have cost me hundreds of thousands for legal, for my back office. So I like the idea of the democratization of venture, and I think the solo GP is one of the manifestations of it. So it's great. We co-invest with, I do have a co-founder, but we co-invest with many solo GPs and think they're a great addition to the ecosystem.
Yeah, I mean, I like to tell founders in the US, if the terms are clean and the money's green, like, take it. And I think that there's so much focus on sort of, where are you located? What sort of portfolio support do you have? What does your team look like? Like, hey, you're an early stage founder, someone wants to give you a term sheet, and they're not trying to do anything weird on the cap table. If you take that money, then you can go back to building and create something much, much, much bigger and have your choice of any investor in the world. And I think the perfect is often the enemy of the good. And so if it's a solo GP, if it's 25 GPs in a trench coat, like, who cares if they're going to give you money on fair terms so that you can go build your business? I think that that's what matters a lot more than, is this the VC I've had on my vision board for the last 10 years?
Yeah, I think I love the new models that are coming out, and I think Jenny has pioneered a great model, so has Sarah, and you guys should talk to them afterwards about this, but I think from the solo GP perspective, I think the only thing is to really figure out like their bandwidth to really help you, especially if you're pre-Series A. If they have a portfolio of 100 companies and they're promising all sorts of things, it's just a matter of time. On the flip side, like if you're going after a big firm that has 25 partners and they have a good reputation, definitely do the referencing on the partner that you're actually going to work with. Sometimes you'll get a partner, but then they'll give you an associate. So I think talking to other founders before you sign on, whether it's solo or like a multi-stage fund, do your homework, because you're going to be like living with these people for a long time, and they can really affect your journey and your ability to get to the next stage.
It may last longer than your marriage sometimes.
I'm sorry?
Your relationship with your GP may last longer than your marriage for some founders. So
definitely in America, for sure.
So do your homework, do your due diligence. Yeah. So Jenny, you were touching base a little bit on party rounds. So we'd love to know from our panelists, what is your views on party round of those founders getting like sometimes 30, 50 angels joining. I think Justin kind of done a massive party round with the company in a legal space. What are your views on that? What are you, and did you have any of your portfolio who did it, and what happened? What are pro and cons?
Yeah, I mean, to be honest, I'm seeing some repercussions of these party rounds where you have lots of people, but no one really to step up. So I think if the company is going gangbusters, it doesn't matter, right? You're going to get to your next investor, your next round, you're going to be fine. I think what happens is if the company's taking a little bit longer, you need to go back to your investors for a little more cash. no one really wants to step up because there's no one that was a lead. So, I see it both ways. I like the idea of a party round. You can just do it quickly. You're not relying on a lead. You can get your rounds done quickly. The repercussions in down markets like this can be a little bit harsh with founders where they really have no one to support them, right? If Eva's on your cap table, she's going to be there for you and to help you get to your next level. And that's a really incredible resource to have. So you just don't have that in a party round.
I mean, if you have 30 people who want to write you, $10,000, $50,000, $100,000 checks, like you have a lot of rich friends, and that's great. And so I wouldn't say turn it down. Certainly, I lead rounds for a reason, which is most people don't have 30 people who are begging them to take their 100K checks, right? And if you do, then the odds that there is an institutional investor who wants to give you even more money is probably relatively high. So with all of this stuff, I'm neutral. I think it's a second order question. The first order question is, do you have other options, right? If you have people who want to give you a party round or a solo GP or whatever, but you're not sure because you heard on a panel once that wasn't the perfect way to do it, but your other option is no money and not starting a company, then try to figure out how to take the money. And if you are, and sort of have the great good fortune of being in a position where you get to pick and choose, I do think that, as Jenny was saying, the people who only went with party round money and turned down the VCs because they didn't want somebody to have a board seat or control are now finding that the party's over and none of their party friends are answering their calls, and that's not ideal. So I think if you can get the best of both worlds, awesome. But if it's one or the other, take it, put the money in the bank, go execute, and build a multi-billion-dollar company. Because I think in the words of Mark Andreessen, revenue solves all known problems. It doesn't matter at that point.
I don't have to add, they did a great job. So.
No, I agree with Sarah. I was part of this kind of party round where I think now 40, 50 angels, but they have one big fund who took the largest chunk. So they have the money, and then they have the network and bandwidth time. But then it's a community you have to manage. So it's a very unique way to raise money, but there's definitely some possibility there. So what do you think have been the biggest change on the last 12 months on raising seed round for founders?
I think it's a lot harder, sadly, and I think it's disproportionately harder for diverse founders, female and people of color. I don't have the hard math. I only have bits of data. I think we're all part of an organization in America in the US called Allraise, where we've been advocating for more diverse funders and founders, and we've been tracking the numbers. So that's a sad part. I think we went through COVID where diverse founders and funders were hurt, and then we ride right into these market conditions, and it's a double down. So, we're very aware of it and trying to do our small part. But yeah, it's hard for founders out there. It's hard for founders who are raising. It's hard for founders who have some capital and now going through layoffs. It's a frickin' tough time. And, I think the best we can do as investors is try to be there for you and have the right, level of empathy to know that, when you do your first riff, it's not fun. And it's not just about ripping the Band-Aid off and just getting rid of 5 people. These are 5 people's lives that you're affecting. And for many founders, this is their first time. So I think, that's our perspective. We're really trying to work closely with founders and navigating, these challenging times.
Listen, I built 2 companies, my first one in 2007, my second one in 2010, downturns. I wasn't expecting to raise venture capital. I had to build a profitable business. And I think we've gotten away from that mentality to some extent over the last few years because we've all been fueled by venture capital, or founders have. So I think the biggest change is just this is a reset of mentality, right? And so I think we're all thinking about fundamentals differently. We're thinking about business creation, unit economics in a different way. Ultimately, although it stings, and I guess I'm a founder too, so I get it, it stings. It's harder for me to raise from LPs, but I think this whole reset is healthy, right? I think what was happening the last few years was just a bit of a hysteria, and I'm kind of glad that things are settling down. Now, I have an incredible amount of sympathy for founders who are raising. Again, it's harder for me to raise my funds as well, but I think this reset is actually really good for the whole ecosystem.
I mean, we live in a world that has cycles, and like they say on Project Runway, one day you're in, the next you're out, right? And so the reality is that things will go up and things will go down. I spend a lot of time on TV talking about, the macro situation, which TLDR, we're fucked, and it's going to suck for a couple years. But we didn't choose that, just the same way that 2 years ago, everything was going great, and we didn't choose that either, right? And so I think that taking the long view of, when things are good, what can you do? When things are bad, what can you do? And just doing those things. When things are good, you raise more money. When things are bad, you conserve more money, right? It might be cheaper to acquire customers right now or cheaper to hire, but it's also, you might be able to renegotiate office space terms or whatever it is. And so I don't have sort of a positive negative view on it. It's just, this is what's in front of us. How do we get through it? But I think understanding it's a cycle and it won't last forever is important. And understanding sort of that it is happening. If it's easy as a startup founder, and I've been one myself, to be so focused on the thing in front of you that you don't spend very much time reading headlines, right? And I don't know, depending on what country you're from, right? Whatever your version of the stock market is, and it's not a bad idea to just look at the NASDAQ in the US, right? If those companies, if the NASDAQ is down, which is the big stock market that most tech companies are on, if that's down 20%, you're probably not going to be able to raise your valuation 20%, right? Because the entire system, the macro headwinds are down, right? If Mark Zuckerberg personally lost 100 billion US off of his net worth this year, which is a higher GDP than some of the countries that you guys are coming from, like, that's going to be a huge impact, right, on tech. And it doesn't mean that you need to be like day trading and watching the stocks minute by minute, but keeping some awareness of what's happening in the world around you and what does that mean for you. If you've been saying, I'm the Klarna of Brazil, great, Klarna's down 70%. So you probably might want to change your tagline, right? And so I think that cycles will happen, but being smart and responsive is a great way to show VCs that you're thoughtful and that you're not somebody who only thrives when it's sort of an easier time to thrive.
So we touched that a little bit about runway, but a question I heard some VCs saying you should have 30 months of runway. Usually it was more 18 to 24. So what is your take on that? Or how long should be your runway? And when should you go again raise money?
The longer the better. Jenny, you go.
I mean,
yeah.
I don't have a month. Like when I meet the founder, it's very bespoke to them. I think I'm actually looking for someone that understands cash flow management and that can adjust, right? Because you might need to do layoffs, you might need to get more scrappy at certain times. So, I think 36 months, I mean, it's a lot of cash to hold, and you're going to be taking that at a lower valuation. So I think you have to be sensible, make sure you can get through 2023, and then get really good as a CEO at cash management, which I was not when I built my first company. It wasn't really the skill set I had. I learned the hard way when we almost ran out of cash. So I really look for founders that have kind of a good sense of actually the fundamentals of their business.
Yeah, I think, sorry, Sarah, please.
So I think 2 years, if you can make it work for 2 years, is not a bad place to be. And then the other thing that I would say is just kind of constantly be open to fundraising. You don't need to be actively fundraising, but if you're going to come to a conference like this, you think you might have a lead on something, or somebody says, hey, I'd be interested in giving you money in this environment. It's not a bad idea to have a safe or a KISS or something where you're kind of just constantly taking in that sort of long tail party round where you can get it, because an extra month of runway here or there, especially in this environment, I think really adds up.
Yeah, I think my only point is I think a lot of founders who have not gone through a cycle, and honestly a lot of young VCs, they think this is going to be over by next summer. Like, I'm no oracle, so I guess I'm being taped and I could be very wrong, but this could go on for quite a while. So whatever you need to do, just get the right capital, be with the right people to support you through this time, and you'll get through it, but it takes a lot more thoughtfulness than before.
Okay, we have less than 1 minute left, so super briefly, what are your take on the new VC model emerging? Jenny mentioned the angel list rolling funds. Do you think we're going to see more of those models? Some of them are going to take more space. What are your take on the new VC models?
You made one, so go for it. Yeah.
I mean, we're investing in innovators, so I think we need to be innovative. And so at the fund, what we tried to do was deconstruct some of the things that we didn't think were working. And so as a fund that does high volume, we have 230 investments, we try to do a many-to-many model where we support our portfolio through our founder and operator community. So I love these new models, and I think that is the future of venture.
VC, like 99% of all wealth management and money management in the world are old white dudes, and so anything that disrupts that model, I am all for.
Okay, I think we'll end up on that note.
Great.
Thanks a lot. Please join me to thank the panelists, and all the best for your fundraiser.